Good morning, and as promised, we're talking about Intuitive Surgical today, mostly for the reason that the stock's down 5.5% already today, off an earnings report they just released yesterday after market. So we're going to take a look and see why this is the response we're getting. So, obviously, some things to note. If you look over the past year, the stock hasn't necessarily popped off by any means, up 24% in the last year. But when you take into consideration everything that's really gone on this last year, in which they've kind of been hampered to an extent, so there's a slight limitation on what they were able to do because a lot of hospitals dedicating a lot more resources to specifically COVID as opposed to elective surgeries, and even sometimes making people wait on non-elective surgeries. But so it is worth considering. So let's take a look at these earnings real quick. Honestly, if I look at these numbers, I'm kind of surprised to see a non-GAAP EPS of 3.58 beats by 47 cents, and a GAAP EPS of 3.02 beats by 57 cents. That's a really good beat. And to even see a beat in terms of revenue, pretty nice. 1.33 billion, up 3.9% year over year. Those are actually really good numbers from what I was expecting. I didn't necessarily expect them to hit their goals there. I thought it would be flat or negative year over year, actually, in terms of revenue, just because of the macro environment right now. So I'm actually pretty shocked by their ability to do that. You see, DaVinci Systems were shipped were 326, which is down 3% year over year. So there was an initial positive reaction, obviously, but then immediately turned to negative. We'll look at this press release too, see if we can find anything more about it. So, worldwide DaVinci procedures increased by 6% compared to the fourth quarter of 2019. So, continued disruption caused by the pandemic, as I said. So really, that number should have increased by quite a bit. But there's a very big limitation right now in terms of surgeries that people can have on a lot of hospitals. So even the ones that already have these DaVinci systems, and it's a reason why they didn't see an increase in terms of a bigger increase in terms of DaVinci systems delivered, is because not a lot of hospitals wanted to pay for them right now. Some are struggling to even hire or to keep their current staff employed, So that is definitely something you have to consider there. Overall, 3% decrease year over year in systems shipped, but again, they're shipping more systems, which overall will lead to more surgeries in the future, or procedures, whatever they like to call them. So the company grew its DaVinci surgical system increase base to 5,989 systems as of December 31st, an increase of 7% compared to 5,582 at the end of fourth quarter 2019. So you see, even in this pandemic, they've managed to grow systems deliveries, which is pretty nice. It is good to see that because they're growing this install base, which means I think their numbers could blow out of the water once we get hospitals back to a normal state. Fourth quarter revenue 1.33 billion, increased 4% compared to 1.28 billion in the fourth quarter of 2019. GAAP net income was 365 million compared to 358 million in the fourth quarter of 2019. Overall, still it is a growth in net income, not bad at all, nothing crazy. But comparative to their revenue, I think that's a pretty good number. 365 million compares to 1.33 billion in terms of revenue. That's a pretty good net income line there. Non-GAAP net income of 434 compares to 417. So you see slight growth there. And operating expenses included a $25 million contribution to the Intuitive Foundation. So from a financial summary, we obviously saw the net income line. We saw that line. Highest fourth quarter revenue ever was driven by, obviously, procedure volume. offset by fewer system placements, as I mentioned there, and the impact was pretty significant. So in here they'll talk about the impact and how it's really limiting the number of people that are first off having the procedures done and hospitals that are purchasing them. So it's worth noting. I do want to see if we got this. You know what we're looking for. Balance sheet. Let's take a look if we got this balance sheet, baby. I mean, there was a shortened balance sheet, which, you know, we're fine with that. Quite consolidated. Overall, we have no current. It's all about this. Liabilities and assets. Total assets right now, give me a year-over-year comparison, sitting at $11.1 billion. That compares to $9.7 billion of a year prior. A lot of that's really just due to an increase in cash position or cash equivalents. And then from a liability standpoint, you're only sitting at $1.4 billion compared to $1.44 billion of a year prior. So they actually saw a decrease in liabilities, but an increase of around $1.5 billion in terms of assets. So quite a good improvement there. You see stockholder equity rise to $9.7 billion. That compares to $8.2 billion of just a year ago. So even in a year in which they were highly disrupted by everything going on, they managed to grow this balance sheet quite nicely. And I think it's a really good balance sheet for a company of this size where it's at right now. We're talking about annualized revenue close to $4 billion. And to have a balance sheet of this stature is pretty nice. An equity of really over 2 times that value is pretty nice. Just from looking at it, you may wonder why the stock's down after results that are actually pretty impressive. Just from my initial reaction to this, I think there's a decent chance that it's because some investors might believe the stock's overbought. I mean, you look at the valuation; it's not out of this world over the last 5 years, up 300%. That's not crazy, but a PE ratio of 85, a market cap sitting around $88 billion when the company's bringing in only $4 billion in revenue. I think that's a cause for a concern on valuation potentially, even though they did perform very well, and I think they will continue to perform very well, especially once we get out of this negative impact that they're facing right now. I personally don't think the stock is low where I would buy it, because I do think this is one that could get hit pretty hard in case we were to see another downturn. I do think that there's a chance that this stock gets hit pretty hard, because, well, if we see continued disruption in their chain, maybe people move on. You know, it's hard to say. I don't think we're talking about absurd levels because the company is actually in decent shape, but the valuation is cause to be concerned. My assumption is it's just potentially overbought, and that's why we're seeing this decrease. If there's something I missed, we'll take a look at it. We'll take a look, but I'll let you know if I see anything different. Let me know in the comments if you have any input on this stock. Let me know what you think of it.